Good morning, everyone, and welcome to our first results presentation. Today, we're going to run through a few things. We're going to do a bit of a recap about who we are as AIS, and then we're going to get into the results, which Andy King, our CFO, will go through in some detail. Then we'll talk about a little bit of highlights around the segments that we split the business into. And then finally, we'll look at the FY26 outlook and guidance. Next slide, please, Simon. Yeah, as a snapshot, we're a 336 million business on a pro forma revenue basis. We generated 59 million of EBITDA, again on a pro forma basis. We operate in 14 countries with 22 locations. We've got a deep background of IP with 180 patents and 93 type approvals. We've got a current order book of around $220 million, which gives us a really good base for 2026. And as a business, we're comprised of 800 people. Most are in direct production and engineering. Next slide, please. So we've, to try and simplify the business a little bit, we split it into segments. So the subsea segment basically covers our subsea ancillaries, water intake risers, and offshore wind products. They are essentially engineered and leave the factory ready for installation. Thermal work is often carried on at site, and it's all about protection against fire, explosion, hot or cold, and that includes our insulation, fire protection, battery protection products. And then the marine business is quayside fenders, vessel fenders, floats, that type of thing, and is relevant to the Oven acquisition that we'll cover in some detail as we go through. All those segments operate in the traditional markets, what we term non-renewable, but which is effectively oil and gas, and also energy transition, so fixed offshore wind, for example, and then also new and up and coming. So thermal, for example, would be fire protection of cable trays for nuclear applications. As a business, we tend to deal with blue chip customers. There's a whole range of logos on the bottom of the slide. They're our typical customers. Next slide, please. To try and capture what we are in one slide, we're a business that produces protective products that are applied in mission critical applications. We are a diversified industrial group at the forefront of the global energy transition, and we target high value, high growth niches where there are significant barriers to entry, which means that competition is low and margins are reasonably good. Our products protect key infrastructure across critical industries. We have global operations, and we effectively have a presence in all major energy producing regions to help support our customers. We have a unique range of innovative material science solutions. They're all high performance in nature, many of which are patented. And then when you put all that together, we've done it for several years, we've got a proven track record and a clear growth strategy, the key elements of which are disciplined organic expansion and to targeted strategic acquisition. Next slide, please. As we said, we've got a whole toolbox of resin technologies that we can deploy. And if we look at the pictures, they give some examples. So the top left picture is a phenolic application for fire protection of a deck, and that's actually on the Scarborough project. The top right picture shows our silicone subsea insulation, which has been deployed onto a subsea tree that sits on the wellhead. The bottom left picture shows the rubber connecting hose for a water intake riser system, which is a system designed to reduce carbon footprint of offshore installations by pulling colder water up from deep, which reduces the cooling costs. And then finally, the picture on the right shows our rotated buoyancy modules, which are made from epoxy. They're designed to mitigate pipe buckling and were developed in conjunction with Chevron. Next slide, please. So now we're going to move into the results. So if you can go on to the next slide. So just as the bullets, we've outperformed the prospectus numbers, and Andy will talk about these in more detail in the coming slides. But in terms of highlights, we've done 335 million of revenue, 59 million of pro forma EBITDA, 25.8 million of pro forma NPAT, generating 6.1 cents per share. Net cash position, excluding lease liabilities, is 1.5 million. And as I said in the beginning, we've got a strong order book of 220 million. So the next slide, the results in a bit more detail, and Andy King will take you through those.
Oh yeah, thanks Andrew. And so following on from the previous summary slide, the next two slides that we'll look at will add a little more colour to those headline numbers for FY25. So on the first slide, this table shows in a little more detail the actual pro forma performance versus both the prior year and against the numbers trailed in the prospectus. So you can see from the table versus FY24, there's significant improvement across all metrics, whilst the more modest improvements over the prospectus indicate that we have a pretty good, robust and well-controlled forecasting process. Just to touch on the Oven business, this was acquired in mid-September, and as such has only been under AIH control for about 14 days prior to the year end. So the overall result for Oven was negatively impacted by delayed contract phasing, which has seen revenue slip from FY25 into the first quarter of FY26. However, the base business performed well above expectations, which more than made up for the shortfall in Oven. So we'll cover some of the more specific reasons for these improvements. On the next slide, please. So on this slide, we focus a little more on the base business. So just to be clear, that is excluding the impact of Oven, where overall we see even better improvements over both FY24 and the prospectus. Looking at FY24, overall revenue was up by $41 million or 15.4%. Or if you want to look on a constant currency basis, that's $26 million and 10% growth. And that was mainly driven by strong growth in the subsea segment. Gross margin percent also improved significantly, driven by tight cost control, some purchasing gains, and some firm project management. Overhead expense increased due to increased staff headcount and energy costs, but still remained at around a constant 18% of revenues. The additional gross margin drove the significant improvement in EBITDA by some $18.6 million, a 51% improvement over FY24, or again on a constant currency basis, $16.6 million and 44%. Turning to the comparison against the prospectus, revenues and gross margin percent were all slightly improved, giving an increase in gross margin quantum of around $1.8 million. Overhead savings of $2 million were achieved, mainly due to tighter expense control, but also R&D tax credits. So just to elaborate on that a little bit more, R&D tax credits are a UK tax incentive for investments in unique R&D spend. It's an annually recurring cash-based award, and because of that, accounting guidelines indicate it should be treated as other income rather than as a credit to the tax line. So in FY25, we achieved around about $0.9 million worth of tax credits, and this amount varies from year to year depending on what we spend and on the view of the UK tax authorities as to what is and what is not allowable. The tighter cost controls added another $0.6 million. So combined, the gross margin improvements and overhead savings added $3.8 million to the EBITDA versus the prospectus. So this then flows down through the P&L to give an improvement in the NPAT quantum of $2.2 million, or at 7.6% on revenues. That's just under an 11% increase over the prospectus. I'll now hand back to Andrew to continue the more interesting part of the presentation.
Next slide, please, Sam. So yes, as Andy said, the subsea segment, which comprises subsea ancillaries, water intake rise, and offshore wind, performed very well in the period, with substantial growth. And some of the highlights in this segment that we achieved during the year, we increased our polyurethane processing capacity and also capability by installing equipment locally in Brazil and the UAE. So not only does that increase our capacity, it brings us closer to the customer and it gives us a broader scope to increase our market share. We continue to see a lot of repeat orders, particularly for subsea ancillaries from Brazilian flexible pipe manufacturers. We see that continuing in the coming years, and that's a solid base of work for us. We've expanded our engineering and project execution teams in Malaysia, which allows us to cover more time zones in the world and be closer to our customers in the Far East and deliver a better service. We've diversified our customer base for offshore wind cable protection systems. We've added new customers to that area, and therefore we're slowly increasing our market share. And then an example of how we work together as a group and the cross-selling opportunities is we executed a project in the Middle East to supply 5,000 ballasts and 7,000 meters of ballasted cable protection. It was designed in France and UK as a combined job, and then locally manufactured through our facilities in the Middle East. And that's a good example of how we can leverage the group's capabilities for global projects. Next slide, please. So as I said, thermal is all to do with fire protection, heat and cold. Some small growth in this, but we are a portfolio business. We don't always grow in all areas, but this was a solid performance, and we did make some really good inroads that position us for the future really quite well. So we increased our market share for subsea insulation covers. And again, that was a combination of multi-site, multi-engineering efforts to come up with what was really a compelling commercial proposition. We developed a range of potting compounds for battery protection for vehicles, and we anticipate getting revenues for that in FY26. We acquired CAPSI, which was one of the largest battery testing facilities in Europe, to establish our advanced Innergy testing business, and we're slowly building that out and increasing capabilities as we go along. And then a good one for us, we substantially increased our revenue in Brazil from operating expenditure, not capital expenditure, with the introduction of 2 new products. We introduced a patented fire protection product for the protection of offshore pipe repairs, which is being adopted by Petrobras. And we also implemented a fire protection system for exhausts of mining equipment. Next slide, please. So the marine segment, our smallest segment, but some good milestones here. We successfully trialed some large frame fenders at an international defence company, basically for the mooring of warships, and that will lead to significant future opportunities. Obviously, the biggest thing that we did in this area is we acquired Oven, and that has effectively tripled our marine segment. To remind people, that's a Norwegian-based specialist high-tech polymer products and solutions business that's given us access to aquaculture and increased our range of navigation aids. So the integration is progressing. It's going really well. You never quite know what you're going to buy till you get it, and we've been very pleased with what we've got. A high-quality team of people, very easily integrated into our sales structure. So we've now got much better capability and product range to take to the market. And we have identified synergy savings, and we've had a couple of quick wins. They're quite low level at the moment, but we can see where we're going to get greater synergies as we progress. Next slide. So moving on to FY26 and the outlook, our three growth drivers remain the same. We're looking to expand our market share in the core markets, either through a little bit of product innovation that we'll talk about, but also by capitalizing on the accelerating investment in energy products by a lot of operators, and particularly in deep water, which is our sweet spot. As I just said, innovation and product development, we are looking to innovate and tweak our existing products. We're not doing very much research, but we are doing development to expand the capabilities of what we have, and look to adjacent markets as well. And then also a targeted M&A strategy that will either give us some consolidation, improve our product range and offering, or access to new geographies. Next slide, please. So a little bit more detail in the core markets. An important point for us is a lot of our top 10 customers have multi-billion backlogs extending way beyond 2 years, which for us means that they've got a lot of work they've yet to place. We do get a lot of repeat work, so we know they've got work that's coming our way, and that's borne out in our pipeline of opportunities. We're also seeing increasing levels of inquiries and opportunities in new geographies, particularly Guyana, Suriname, Mozambique, and Namibia. And we are looking to expand the breadth of our product ranges, little tweaks here and there, which give us access to a little bit more market. And then, as I talked about with Brazil, with our pipe protection jackets, we are looking to brownfield asset flight extensions and monitorizing that, as we've done in Brazil, and extending that into the more developed basins around the world. So in terms of the drivers in our core markets, the general non-renewable oil and gas spend is forecast to grow at around 10% per annum from 24 to 27. And a lot of that will be spent on deep water projects, as I just previously said, and that's due to favorable economics. So that's right in our wheelhouse, and that's a really good opportunity for us going forward. In terms of energy transition, global offshore wind is still set to increase. A lot of it's focused in Europe and the UK, but what we're looking at growth rates of around about 20% CAGR from 2024 to 2030. And the opportunity for battery protection products for EVs is expanding. The number of cars is forecast to increase from 25 to 32 at a rate just less than 10% per annum CAGR. Next slide, please. So again, as we mentioned, innovation and product development, it's really in the DNA of the business. We are a materials science business. We have an extensive team of engineers and scientists who are all looking for the next development and working on development of new applications, new products. We have a team of over 60 people working on this. And we have a very strong track record of being able to develop new products to solve problems in the marketplace, and we have a reputation for doing that. So we are looking at new products in adjacent markets with existing technology. As I mentioned, we're looking at cable protection for nuclear. We are looking to expand lithium-ion battery protection products and running testing and trials with a number of leading global OEMs that we expect to lead to work in the next couple of years. And then we're also looking to take our existing offerings for subsea protection and combine them with sensor technology to be able to adapt that for use in defense applications. Next slide, please. We have a targeted M&A strategy. We're looking to consolidate in key markets, expand our product portfolio, and we're looking for areas that we're not really very present in. APAC represents a really good opportunity for that, to establish a local presence in Australia, and it's very much an untapped market for us. We have developed a very clear pipeline. We've got about 20 potential acquisitions that we're screening at the moment, all at various stages. Some are in advanced discussions, and some are very early stage. But you will see activity in this area in the next 12 months. Next slide. So really to summarize, there are positive long-term forecast growth drivers across all of our product ranges and market segments. We have an extensive pipeline of opportunity in excess of $2.4 billion, representing work for the next 2 to 3 years. At the start of FY26, we've got a very healthy order book relative to history, with 50% of our business already covered. And as I mentioned before, a lot of what we get is repeat revenue from repeat customers based on long-term relationships. And we know that those customers have got substantial backlog, so we know work's coming. So we are reconfirming our guidance that was in the prospectus. So our forecast for underlying revenue remains at 387.9 million, and for EBITDA it remains at 62.3 million. And due to the sort of normal timing of the contracts within the order book, we expect revenue phasing to be in line with prior periods. And obviously this financial guidance does exclude any incremental upside from any M&A that we do in the rest of the year. So thank you very much. I'll pass you back to Simon, and happy to take some questions.
Perfect. Thanks, Andrew, and thanks, Andy. First couple of questions just around Oven. Perhaps you can give us some colour as to the acquisition and what you've found since actually owning the business, noting that it was only 12 to 14 days before the end of the year that you actually acquired it.
Yeah, well, when you make an acquisition, you do as much due diligence as you can, but you never quite know what you're going to get till you spend some time with the people and really get to know the business. And we've been really pleased. The team of people they've put together are really excellent. Culturally and value-wise, they've really fitted in well with the rest of the group. And they're cooperating with everything we're doing and really grasping what we want to drive towards, and we can see a lot of synergies. For example, their rotor molding capability will deliver us a 25% cost saving on the rotor moldings we buy that will slowly work its way through the system as it goes through bids. So we're really quite excited about it. They're a very solid, very well managed, excellent acquisition, actually.
Just a question, how much total capacity do you have to deploy for M&A?
We think we have around about $100 million of firepower, and that will keep leverage to below 2.
Just a follow-up question there. You're pursuing global acquisitions, including underserved geographies like APAC. How high a priority is adding more battery/EV technical capability or OEM relationships through M&A versus organic build-out?
We have some opportunities in that space, but we've got a whole suite of opportunities, and we're going to assess them against criteria of margin, whether we think we can cross-sell. So we're not sort of particularly targeting any one technology. We're going to look at which assets give us the biggest bang for the buck, really, against the criteria we've set ourselves.
And you mentioned the customer backlog of several large customers extending 2+ years. Can you just provide some further insights on this?
Yeah, it's really a follow-on to some of the quarterly results some of our customers have presented. So, in particular, you're talking about Saipem, you're talking about Subsea 7, who've got a record backlog. You're talking about Technip, who've got a multi-year backlog, all of which are in our top 10 customers.
Perfect. We've just got a question from Nick Rawlinson at Morgans. Nick, you should be unmuted now. Please go ahead. Sorry, Nick, you'll just have to unmute yourself. Sorry, Nick, you there? Can't hear you at the moment. We might just come back to Nick once we sort that out. Just the next question, just around defence applications as a new area of development. You mentioned that. How do you see your products being used in this market?
Well, we could tell you, we'd have to kill you, Simon. But no, seriously, it's highly sensitive, so we can't go into too much detail. But we are working with some defence companies in the UK to look at opportunities around sensors and protection, essentially.
Just try Nick again.
Can you guys hear me now?
Perfectly.
I can hear Nick.
Great, thanks, guys. Andrew and Andy, thanks for taking my questions. Appreciate you've given some industry forecasts for oil and gas projects to grow at a 10% CAGR, but all the commentary is perhaps even more upbeat than that. Like Suriname and Guyana, amongst a few others, are relatively new markets. Have you ever seen 3 or 4 markets join the subsea oil and gas space in such a short period of time?
In short, no. It's normally in sort of Guyana came on stream a couple of years ago, and that was a new area. I remember Angola kicking off, but I don't remember really more than one. And certainly, Guyana's leading the way. Suriname will follow. Namibia and Mozambique are not far behind. So they're pretty much unprecedented times, really. And they're all deep water, and they seem projects they're looking at seem to have good economics too.
Great. And can you just talk more broadly about the opportunity in battery protection materials, sort of how that would change the nature of your business in respect of, annuity style revenue streams and the like?
Yeah, certainly. So what we're trying to do is effectively get specified on a platform, which which would be the equivalent of a sort of an internal combustion engine going across a whole range of models. Once you're sort of specified, you get a nomination, and that really means that unless something goes badly wrong, your product will be used on that platform for the life of that platform. And the life of a platform is typically 7 years. So there's a couple of years of ramp up, peak, and then a couple of years of tail off. So once you get to that position, you've really secured some revenue for up to 7 years. And those opportunities are dependent upon what you're supplying. The largest scale would be sort of cell dividers that could be $50 to $100 million a year, down to some of our potting compounds might be £5 to £10 million a year on a platform. So the more platforms we can get on and build that through sort of technical selling activity, the bigger that business becomes.
Right. Thanks, Andrew. And just one last question, if I may. You mentioned a 25% cost saving on rotor molding. How big is that spend in the context of your business?
I've got to translate it to dollars. We currently spend around about $8 million a year on rotor moldings. So the potential cost saving is around about $2 million. I'm not saying that Oven have got the capacity to meet all of our demands, but if they had, then that's the sort of order of magnitude that you would be looking at.
Great. That's it from me. Thanks, guys.
Thanks very much, Nick. Just next question. With such strong growth drivers, it is understandable that pro forma revenue is forecast to rise 15% in FY26, but why is EBITDA only forecast to rise 5%?
Yeah, that's a very good question. The answer to that is that the actual cost of listing is quite extensive. So we have included quite a substantial amount of costs in our overheads to cover that listing cost. So, for example, insurance for a listed business in Australia is 10 times the cost of what it used to be as a private company in the UK. So we've made some fairly prudent budgets in that sort of operating costs area. So that is the reason for those different percentages.
That concludes the Q&A segment. Andrew, if you had any closing remarks, I might just hand it back to you.
No, not really. Thank you all for coming. I hope it was informative, and look forward to speaking to you later. Thank you.